There is so much confusion about investment.
Jason Mahendran is a senior investor at Active Partners, one of the UK's leading investment firms backing high-growth brands.
This impression may be partly driven by social media and other forms of media of needing to really project this image of success. You play the role of the successful entrepreneur and you walk in and that's what you think people need to see. I always advise that people need to think about how open they are to external input. You have to have your own idea and clarity of thought about what you're trying to achieve, but alongside that, you do also need to be open to input. You might have an amazing product, but actually how believable is it that that's going to become a sufficiently large business that's going to attract future investment and future capital and interest from buyers?
Thank you so much for coming here today. I'm very excited to talk to you.
Lovely to be here. Thank you for having me.
Well, 2 times in a week. We did actually have our board meeting yesterday, so your week's just been saturated by...
I'm just going to work here full time.
Exactly, just move in. Just move in. So for the people who are interested in your background, how you got to where you are now, setting the scene on kind of your career, could you give us a little whistle-stop tour of your career and how you got to where you are now?
So I grew up here, just outside London, and then after studying economics at university, was fortunate enough to join the analyst training program at JP Morgan in their mergers and acquisitions team here in London. So working with mid to large corporates on a range of acquisitions, but also fundraising, but in the consumer and retail space. And whilst I was there, I was lucky enough to have the opportunity to be tempted by the sunny shores of Australia and spent 2 years in Sydney. But after that 4-year block, I was really interested to understand what it was like being in a big organisation and being on the other side of the table, really being responsible for the decisions. And so joined the Woolworths Group. This is where I always feel the need to say, not the bankrupt pick and mix retailer, though it was an amazing business, but the largest retail organisation in that market. And so worked there on a range of different strategic and growth initiatives. Prior to then moving to Singapore, where I was for 2.5 years, and I worked for an amazing guy called Brett Blundy, who's a self-made entrepreneur, started his first business at 16, grew it to a multi-billion-dollar empire, really. And I worked there on a range of things, new investments through to realising value from some of the existing investments, before coming back to London, and where I've been for the last 5.5 years, working for Active Partners. We're a consumer-focused investment team looking to back the iconic brands of tomorrow.
Wow. You're welcome. The opportunity. And the best way we can give people context before we go into, how you get investment, whether you should get investment and all of that, is for you to tell us a little bit more about Active now and what type of check size you do, what type of businesses you invest in, and all of that.
Yeah, sure. So it's an exciting part of the market to be in. So we are completely focused on consumer brands, and we, like I said, look for the brands that we think are really going to last the test of time. We, from a check size point of view, are investing typically upwards of £5 million, and our businesses are typically at the point at which we invest run rating from a revenue perspective at around £5 million. So when you look at this kind of scale of the business, that's where they're at. The things that we really look for are, like I said, brands that have a point of view and a point of difference. They have amazing levels of consumer engagement typically, so there's just this amazing buzz around them. I feel like I'm just sat here talking about TALA, by the way, but that's obviously why we are working together. But fundamentally, they're also led by founders who have really ambitious plans and want to work with a partner to help bring that ambition to life, and that's something that as investors is really, really important.
So you're in the consumer goods space, but also kind of in that private equity group kind of title. What other types of investment could a founder who is ticking all of the boxes that you just mentioned, what other types of investment could they be looking for? Yeah,
so it's a really good question, because I think there is so much confusion about investment and what does it mean and where can it come from, and I think often it just gets bucketed into
absolutely,
I'm either going to have investment or I'm not going to have investment, and so the way that we think about it to try to break that down to people is at the start of your journey, if you want to raise capital, the place where people would typically go to is some form of angel type investment. So there might be, if you're fortunate enough to have a network where you can access people from friends and family perspective, then you can go ahead and do that, and that will be it's a great way to get some funding into the business and get off the ground. From there, I think then it's easy to think about it as the stage of business as it grows and split the investment landscape up in that way. So after that friends and family angel round, that's where lots of people, businesses and founders may look to the venture capital, the VC space. And those are typically funds that are, or investors that are looking to back a number of businesses. And often that can be quite technology focused. And often it can be about seeking out the next unicorn, and you're really looking for like the next big thing. But what that means inherently is, as an investor, some of your businesses may not get there and are less likely to succeed. And then after that stage, we think about the growth capital market more than private equity. And that's where we at Active sit. And the way that we think about that, or the way that we would define that, is it's businesses that have already proven that there is demand for what they want to do. And now they're looking for capital as well as a like-minded partner to scale on that journey, before then probably getting into the more traditional private equity space. And in that traditional private equity space, businesses are even larger still. And often there can be a mix of capital that goes into the business as well as capital that goes out to existing shareholders. One of the key defining factors of private equity is the use of debt in that market. And that's really not something that we're doing in the growth capital space, and certainly not much of it in the venture capital space. They're typically larger businesses, even further still at private equity, with debt that can be used in those situations. And then outside of that, there are lots of other options as well, whether those are family offices, whether those are actually just borrowing debt as a business and deciding not to go for an equity type of round. So that's how we think about the spectrum of investment, and there's lots of complexity and nuance within that. Yeah,
absolutely. And I would say that, one of the main reasons I was really keen to do this episode and to talk to you as well is the fact that actually, absolutely, as you say, there is this kind of bucket of investment, non-investment. It's like you either bootstrap or you get investment. And actually, if you break out that investment, if you have a private high wealth investor versus a VC versus PE versus raising debt and any of those kind of various different things, there are so many differences, both in terms of what would work for your business, but also in terms of the type of business you want to build. And I remember when we first decided that we were going to be raising for TALA, and I was kind of doing all of this research, it was so confusing. It was like, okay, but this is here, but this thing says it's this, but actually it only invests in this size, and I don't know, some of the biggest funds, for example, are looking at consumer, but really what they want from consumer is tech that's going to 10x within 2 days. Yeah. And it's kind of all of these different, as you say, nuances within the space, but also a huge amount of confusion. So I'd really like today to talk about, where investment might be right, where investment might be wrong, but also the brands themselves, and for people who might be looking for investment or looking to the next stage of their kind of founder and entrepreneurial journey, what they really need to be kind of working towards to kind of get to that space. Yep. So you talk about brands that have strong customer engagement, good growth potential, fit their industry knowledge, and are kind of built by visionary founders. Why are those things so important to you as an investor?
If we start with founders and having a clear ambition and point of view, I think that sounds like such a cliche, right? But business and success within business, people is such a big part of that. And so a founder that not only has a clear idea of what problem they're trying to solve for in our landscape for the consumer, but also the right level of ambition and the willingness to build that right team around them is really important. So starting for us with what's exciting about this individual, do they have a plan for what they're trying to do, and do they want to get like-minded people around them is really, really critical. And a really big part of that is when people think about getting investment, I always advise that people need to think about how open they are to external input. It's a balance, right? Because you have to have your own idea and clarity of thought about what you're trying to achieve. But alongside that, you do also need to be open to input and recognise you don't know it all, and other people, whether those people in your team or your investors, are going to just bring different kinds of experiences, different kinds of perspectives. But an individual who has that balance, I think, over time I've seen is a really, really critical ingredient to success. And then if we go on to scale potential, it's really great if you've got an amazing kombucha subscription service idea that's only focused on turmeric infusions or whatever it might be. But we look at that and go, that is wonderful. You might have an amazing product. Yeah. But actually, how believable is it that that's going to become a sufficiently large business that's going to attract future investment and future capital and interest from buyers? And so having a point of difference over what you do, but doing it in a way where you're actually accessing a sufficiently large market opportunity is really important, I think, when you're thinking about raising capital from investors. And
just before you continue on that point, I also think one of the most important things is that you don't need to want to be a really big business.
Absolutely. Yeah.
I think that there's this, because of the entrepreneurial kind of rhetoric online at the moment, but also for a long time now, it's this idea that, you know, you do see people growing these billion-dollar businesses. So you kind of think, actually, to be a successful entrepreneur, I need to do X, Y, and Z, and I need to grow like this. And actually, a lot of people, the type of life, if you're trying to create this life of freedom and no boss and being able to work from anywhere, actually that's not going to be a high growth startup that wants to exit within 3 to 5 years. That's just not nowhere.
The reality
near.
is harder than that.
And so, but there's every merit in the fact that you don't want to do that. But that times with getting investment that's looking for growth opportunity, those are not synergistic. Those don't go hand in hand. And I think that one of the most important things that when looking at entrepreneurship, actually being able to break that up into a number of different things, is you can have an incredibly profitable lifestyle business that enables you to go on holiday when you want to go on holiday, and, you know, pursue the 4-hour work week, and, you know, can also be really difficult, but can, you know, pay your bills and do everything you want to do. And that's no less entrepreneurship, but it's a very different type of entrepreneurship from one that's looking for investment. And so really understanding what you want as a founder, I think, is not talked about anywhere near enough within the space, because it means that lots of people think, oh, to be an entrepreneur, I must get VC investment. But actually, to get VC investment and to be a VC-backed company, you're going to be working a lot. You're going to have very clear goals. You're going to have very clear growth strategy. And that is not conducive to this whole kind of freedom entrepreneurship things.
To build on that, though, I think that that comes back to me about profile of investor.
Absolutely.
And actually putting myself in the entrepreneur, putting myself in your shoes, I think that it's really important about being clear on those personal ambitions and then finding investors that have the right kind of cultural fit with that, but also that their return expectations on their investment align with that. So to make that super tangible, if you're going to raise capital from a Silicon Valley style, I could call them traditional, but they haven't actually been around for that long, but traditional venture capital type of firm that is looking for something to grow 100 times in value from the point that they invested, the expectations that investor puts on you is that you do need to deliver that kind of hyper growth. And what that means is their version of success is that you do become a unicorn and you grow to being $1 billion in value, and then they've made an amazing return on their investment. But what that means is if something has got to $50 million of value, they're not so interested, and you may then not get the funding. And what they do is there can be an approach to, again, not to generalize the whole industry, but there can be an approach of pushing businesses to be not so profitable, and that then means that entrepreneurs find themselves in a really difficult place, as opposed to finding an investor and they, you know, that is happy to make a lower return, and they definitely exist, and they just might not be that traditional VC fit.
So I think what I need to clarify then from what I've said is that it's not that if you get investment you have to want this like super high growth kind of probably not sleeping that much, like a lot of it, you know, like this type of thing, versus if you don't, you want to be lifestyle. There's a way you can do both of those things, but I think in terms of absolutely, as you say, as founder profile, but also as your personal ambition as an entrepreneur, working out what you want from your life is very important, both when deciding whether to get investment and then also when deciding what type of investors to go for. And that's also why, we have very ambitious growth plans and at TALA, and we're really excited to kind of go on that journey. But at the same time, it would have been very difficult to be with a heavily tech investor who was actually saying, no, we want you to be worth this within, $1 billion within 2 years. And we'd be like, okay.
Because I think it's just about the reality of different business models. And I think that what we have seen probably in the last 10 years is there has been this application of tech-like thinking to the whole of the investment landscape. And the reality is not all businesses can grow like that, as well as the fact that to sometimes recognize and reach $1 billion type of valuation, you need to have all your stars aligning. And so actually setting an ambition where you go, I'm still going to work exceptionally hard to create a business that might be worth 40 or 50 million. Like that's still an amazing outcome, right? It's a huge number. So, and if you own 20 to 30 to 40% of that as the owned entrepreneur of that business, that's still life-changing and that's still amazing. And having an investor that is aligned with that ambition. But if actually you want to create the next unicorn and that has its own kind of appeal to you, then that's great. And, find investors that also tick that box. Yeah,
absolutely. And so how have those kind of key pinpoints that you go, with customer engagement, growth, founder, visionary, all of that, how have those aspects changed over time and how do you expect them to change within the next few years?
So I think on those list of attributes alongside founder, market, good economics, and the opportunity to exit in the right way, I think those attributes are pretty much fundamental to how investors think about opportunities, and those in and of themselves may not evolve as the headlines. I think how we apply them in different situations, as well as how in our space we think about the consumer and what does consumer engagement mean in practical terms, may evolve over time. So, historically when there wasn't social media, how you would think about consumer engagement was really different, and you would look at how far something was maybe selling through a retail store, or you may look at how much PR coverage something has got. Those things still really matter, but I think the way in which we probably appraise some of those things evolves over time, rather than necessarily those fundamentals evolving over time, if that makes sense.
Yeah, that makes complete sense. And I think on the customer point as well, it's very interesting because I think that from my point of view at least, when I'm looking from a kind of small ticket angel investor perspective, when I'm looking at those companies that actually have amazing customer engagement, regardless of what they've done so far, that almost is able now to tell us a bit more about the future in terms of bringing out a different product that might be really quite different from what the company's done before, but being able to be quite agile in what they're doing, especially with things like the pandemic. If you have an amazing customer base who believes in what you do and your ethos that's beyond just your product, you're almost able to be a lot more kind of future-proof in terms of the way that you can kind of pivot. And I think we've seen that a lot.
Yes, yeah, for sure. I think pace of innovation is effectively one of the factors that underlines those attributes, especially in this market. So think about the businesses that have really been able to build on that understanding of their consumer, have a community that is excited about what they're doing, but can also bring things to market quickly and respond to that. We've got Face Theory and skincare in our portfolio, and they have been so smart with how they have identified the specific ingredients in skincare and be able to bring things to market. I think that type of thinking is another element of how the consumer has evolved with how they behave with brands that allows businesses to ride that trend.
When do you know if it's the right time to kind of, if you've decided that actually investment is what you want to get to be able to take you to the next level, when's it kind of the right time?
There isn't probably a one-size-fits-all answer for that. I think it varies a lot by the individual and their mindset. Did they want to bring in outside capital or not? And again, having assessed the different forms of that. But I also think it varies a lot by the type of business that you're doing and the category that you're in. It can also be a response to market conditions. So is there something happening? And I think having that really clear understanding of what the market is that you're operating in is extremely important when you're thinking about investment. Is it actually a time when competitors are not responding to trends? Is it at a time when maybe it's out of favor with the investor community and actually there's less investment being raised, but that actually might be your opportunity? So I think thinking about your own attributes as an individual, point one. Point two, thinking about the category that you're in and how much capital you might need to get to where you want to get to. And then three, the market that you're in. Those are probably the things that determine the timing, rather than there being an answer that after 6 months is the right time. And I think that, to touch on something you were mentioning earlier, Grace, I think that's also been a potential problem in the industry, that there is this perception that there is one journey
Absolutely.
of how you need to grow this business and when you need to raise your capital. I read this article recently about the alphabet soup in fundraising. You know, you go from your Series A to your B to C and you keep going. But what if you don't need that?
Yeah.
You know, what if your business doesn't need that? So I think recognizing that you're on your own journey, not to overuse the J word, I think is though really actually important.
Yeah, no, absolutely. And I think that a lot of the time, especially when we're kind of seeing, both when we're seeing a lot of bootstrapping success stories that can be really glorified and also, you know, incredible, when people are really able to make a huge amount of success based only on their own kind of internal capital and reinvestment. I also think there's often an aversion to bringing in outside investors based on kind of horror stories of losing control, or, you know, having to report all the time and therefore making short-term decisions versus which actually aren't the right thing, versus kind of long-term decisions just because of that reporting. How does a founder, when they've decided they do want investment and they think it's really going to help them take them to the next level and they think it's the right thing for their lifestyle and their business, how does a founder avoid kind of running into these issues?
Yeah, I think there's definitely those stories out there. I think you said a couple of really super interesting things. I think there's definitely those stories out there. I think some of them do potentially get amplified, and conclusions can be drawn, and there's a lot of complexity in some of those situations. But I also think that there is a right time to raise capital for your business, based on all of those attributes that we just talked about. But when you do decide to do that, finding the right fit and profile and spending time with your investors to understand upfront what are the different options, what's in it for them. Not being afraid to ask difficult questions is something I would encourage. I think people fall into lots of different buckets, but I think there's definitely one school of thought where people go, you know, the investors do know what they're talking about and I need to behave in a certain way. Actually, that's not, it's got to be a two-way relationship. And so being able to upfront ask the kinds of questions, to scenario plan and work through, well, if things go wrong, actually, what do we do here? How might you respond? How might I respond as an entrepreneur? And starting to kind of hear how people think about those things, I think is really important. And then there's just some fundamental things I think people should do to protect themselves. I think, you know, have your own lawyer to state that. Hopefully that doesn't sound too obvious, but I think that sometimes people don't think about how they should fundamentally protect themselves. Get good advice, and have someone on your side of the table as well, but do that in a respectful way, and recognize though that ultimately, if you find the right fit and profile of investor and you've spent time with them, they are aligned with you. You know, you are shareholders together in the same business. So there are things to think about, but it's certainly not horror stories. I think those are the exceptions. And
I would say as well, from what you're saying, it kind of sounds like the majority of those situations, if they do happen to the extent that it's kind of, you know, that whatever story whoever has heard, will often be then based on either having raised at the wrong time or with the wrong person, with the wrong types of partners, and not having the synergy between the type of company you want to build. Because of course, I will, you know, to use examples kind of from our side, I think I would be, when we were raising last year and we were talking to, you know, lots of different people and lots of different types of people, and I was also talking to founders who had raised before, and I was like, tell me all the worst things that can happen, because I was, you know, I had definitely been raised in terms of the types of stories that I read and all of this about either this kind of like Silicon Valley super fast growth, which I didn't want, I didn't think was right for the company, but also the all the kind of like bootstrapping success stories that were like, this is the thing. So this kind of like middle ground for me wasn't hugely apparent and wasn't like, oh, this makes sense. So there were certain aversions that I had to kind of being like, to taking on investment when we were also 2.5 years down the line when we weren't. And as soon as I started talking to people that were kind of being like, oh no, this is what it helps you do, and this is what the right types of people are, and this is what's amazing about it, this is what sometimes goes wrong, you know, all of these different things. I think that kind of education around the idea that there's not just one type of investor, and as much as, you know, when you're in the raising stage, you probably want to get that term sheet and get the deal closed as soon as possible, you also, you know, it's kind of short-term inconvenience probably in asking like all of the questions and getting really, really clear, and you're probably terrified that they'll pull out because you've said like, oh, but we don't want to be worth $1 billion in 3 years, and like all of these things. But that is so important. And I think that once you have that synergy, for us, it was a lot of the kind of the type of company that I want to build that you kind of really supported from the beginning and really, really understood, but also the fact that you really understand consumer, so understand what the issues are that come with that. We don't need to kind of hide and be like, oh, so interestingly, this cost us this much, because that's, you know, the way the industry works. But also those kind of ideas of staying open and honest and using things like board meetings as a forum for discussion around things like strategy, to just like all being on the same side and being able to be like, this is how you make it work. And I'd say that from now my experience of having that, like, it can be really, really fantastic, because you can all sit there and be like, oh God, no, this won't work at all. And you can all agree on that. It's not you reporting to someone, making that kind of open to criticism, that, you know, if you're criticizing something, it's because you want to discuss it, if that makes sense.
Yeah, definitely. I think that the word that we overuse at Active all the time is alignment, and it's just about setting, you use synergy. It's basically the same thing. Is there alignment around the shape of the ambition and the shape of the plan? And then on the reporting point, I think I hear that a lot from entrepreneurs. There is this perception around, oh, but as soon as I get investment, I'm really worried about the extent to which I'm going to have to start creating these reports. And I think that, again, it's about asking the question of investors, what reporting expectations do they have? But exactly what you've just said is right, which is using the interaction with an investor, and not all investors behave like this, but with your investor, using that interaction to think about, yes, let's talk about the numbers and here's what we've achieved, but then also be really forward looking and think about strategy. And so have, again, those conversations with your potential investors up front and go, what are your thoughts on our strategy? Where do you think you can help and support us? What do you think we've got wrong? I think having all of those conversations, and you just set the tone of that kind of interaction, exactly as we had yesterday at our board meeting, is that right platform. But entrepreneurs should play a really proactive role in setting up that dynamic and that dialogue. And it's not something the investor alone needs to set or drive. No,
absolutely. And I'd say that, you know, the decisions that when we kind of touch base outside of board meetings on a founder to investor relationship or founder to board member relationship, it's also that kind of, oh, this has happened, we think this is the best decision, but these are the results of it. You know, what do you think? And kind of being able to bounce off each other. If you have that alignment in terms of what type of company you want to build, those conversations become pretty easy.
Yeah, like, there's no elephant in the room at that point.
It's able to, you know, for example, be like, oh, this is late, which means we need to do 3 launches in this month, and actually that doesn't make sense to us. Like, to me that really affects our brand. I don't like it. I don't like the way it looks on social media. I don't like all of these things. And being able to, you know, if there's that alignment in terms of the company you want to create, those things should, I guess, iron themselves out.
Yeah, absolutely.
And from a pitching point of view, so someone's decided they want investment, they've decided they want investment from you, and they come to pitch to you. Firstly, I'd like to know tell me about one of the best pitches you've seen. What did it entail, and what did you love so much about it?
Okay, so I think that I'm gonna answer the question slightly differently. So I'd first say, the pitch document and what you do in that first meeting is really important. But I also think this is partly one of those assumptions about, and there's things, you know, like the way that Dragon's Den, which I think is an amazing show, but it creates this environment around the pitch and the term elevator pitch and all of these things and terms in the industry make it feel like that moment is be all and end all. But actually, I think that it is important to have a really clear document, and to be able to present it really well. But also, it's one part of, I think, you will remember from when we got to know you and got to learn about TALA, it's a series of interactions.
It might be the foot in the door, but it's unlikely going to close the deal.
Yes, exactly. When I think about the best things, I'm lucky to work in an amazing sector. So I have been in pitches where I've eaten fried chicken and I've had ice cream and I've had a beer and like, but actually I think bringing in those things are memorable.
Should have had you try on our leggings.
Well, thank you that you didn't, and actually maybe we'd be sat here if I was squeezing myself into skin lux. I don't think we'd be here. But I think that bringing that excitement around what you do is memorable for people, and it is really important. And again, I think it's maybe a misconception that investors, and maybe it's partly because of the category that I invest in and active, but I do think it's really important that you get across what you're passionate and what you're excited about. And in consumer and retail, the thing that people are most excited about is the product or service that they're delivering. So bringing that to life, I think, for me has always been really, really memorable. And then alongside that, the fundamentals, I'm now going to kind of slightly contradict everything I just said, but alongside that, I do think the fundamentals are really important. Mm-hmm. Do know your numbers, do present those numbers as well, and then have a plan of what you're actually trying to achieve, both in terms of your business, but also the numbers that you want to hit over the years. But what are some of the best pitches? And the list is really, really, really long. But you know, if I think about some of the things in our portfolio, I do remember meeting Nikolai as the CEO at Taylor & Hart, which is a personalised fine jewellery business, and he didn't bring me an engagement ring.
Get down on one knee.
Yes,
Please bring money.
Invest. No, but what he did get across really well was to take it back to what we were talking about earlier, is that mission and purpose for what he was trying to do. He felt the industry was broken in terms of how people buy engagement rings today, not enough transparency, more about the brand and not about personalization, and a really punchy, compelling explanation of the product and a really clear description of what they do really quickly kind of got my interest. So that explaining what you're passionate about and bringing it to life would be where I would really encourage people to start.
Yeah, absolutely. And when someone wants to be pitching to someone, I think that the industry kind of feels like there's this network that you don't necessarily know how to get into. How do people get those meetings with investors in the first place? Yeah,
it's a good question. I think that there is a reality of a lot of introductions do happen through network, and Absolutely. That is just a function of how the industry has evolved, and it's something that absolutely needs to be thought about differently, and the investment industry has to work harder and better to make it more accessible.
Absolutely.
I think that if you're sat at home in front of your laptop, and that's where all of this type of stuff begins today in reality, there's lots of different ways to approach it. I would say get Googling on what have been businesses that inspire you and find out where they have got funding from, and just start to map out that landscape. And if you just follow those threads, Google an interesting business, Google their last round, so much of that stuff, it's really all publicly available information. See who their investors are, then take that onto LinkedIn if that's really one thing that's there that's available that anyone can access. And you would be surprised at the amount of outreach that we get at Active that is interesting, that we want to engage with, and we will certainly find out more. And so it's not like that option isn't available to people. So that kind of cold outreach via LinkedIn to investors, I think, is really valuable. And then there are larger firms and places to go to that actually will give advice. So those might be networks of other founders, networks of angels. You can also go through other people in your industry, agencies that you might work with, marketing agencies and so on. So I just think creatively about all of the different, and don't be afraid.
So many, because also I think the thing is that you can't necessarily rely on, well, I don't think that I kind of quote unquote networked until like probably 6 months before we started raising, and we didn't, I wasn't necessarily set on kind of raising at that point, so it wasn't that I was going around being like, collect this person in my little black book. And so I I messaged on like Instagram some brands that I was like, you're amazing, I've seen you've like raised from here, and would essentially be like, can I talk to your founder? I'd love to hear about like their investors, because I was really keen as well to find as you would with, I don't know, if you would might be joining a workplace and you kind of know someone who works there, you talk to them about what their experience was like and all of these things. I was probably the biggest pest in the world, just being like, hello, please tell me more about this. And you'd be surprised as well how open people
are help
to,
as well. Yeah.
It can be and I can understand that I will have a very particular experience of that because I have a public platform and all of that. But I would say I know so many people who have ended up getting investment or great contacts and all of this through literally just asking and just kind of outreach.
I think that founder network is really, really strong because it is not easy being a founder. And so the individuals that I think often find themselves that have made the choices to get to that position want to share their learnings. I think it's absolutely the right thing. Don't be afraid to pester people. I think go for it.
Yeah.
You don't know if you don't ask.
Yeah, no, absolutely. And in terms of when you're in that stage of kind of originally talking to a company, listening to a pitch, maybe emailing back and forth with kind of their model and more information.
Yep.
What do you think is the biggest red flag of kind of, nope, definitely not investable?
That's a good question. I think, assuming you've got through the evaluation of an individual and you've spent time with a founder and all of that alignment piece is, if I'm feeling good about that and that has a tick, a lot of it then does come down to the financial plan going forward. And fundamentally, does it all hang together? And what do I mean by that? I mean, from the way that we look at things as growth capital investors at Active, is the business fundamentally able to be profitable? Is it something that is working in terms of the margin that it's making on a product relative to the marketing cost that they're spending to acquire those customers? Yeah. And then alongside that, is there the sufficient cash flow in the plan to deliver the pace of growth? So I would go is it a red flag in and of itself if you find those things? Maybe not, but it comes back to the willingness to talk about it and workshop how we might be able to plan for it differently. And I think that's important. But if I had to think about proper red flags, there are things that we are looking out for. To state the obvious, there shouldn't be any fraud. There shouldn't be a cash disappearing. Tax should be paid. I mean, there are definitely those things that we look at in a detailed diligence process.
Yeah, and I would also say that I think what's quite interesting and what people might not know from, I think because you see, maybe it's like the representation in like films or kind of documentaries or any of these things that kind of feels like someone's been like, yeah, we'll give you the investment. Yeah. And then you get like wired £5 million. And I would say, I mean, we got a term sheet from you, I think it was early September or late August, like around August, that time. And it was August, and we closed the Friday before Christmas.
Yes,
good memory. And during that time, I also think it's key to say the amount of, you do your due diligence. There will be some that are way heavier. There will be some, if you're going with a private investor, it will probably be way lighter. Yeah. But there is also a very thorough process for these things to make sure that, these types of things don't happen in terms of fraud, in terms of taxes, in terms of like all of these different things. And I think it's quite interesting because until you go through that process, you don't necessarily know that, what all of those kind of things entail. And I also think that's part of the decision in terms of deciding, I mean, it will be a very small amount of people who don't want investment just because you're going to do some due diligence, but it's probably more just like insight into the process that we don't necessarily see otherwise.
Yeah, I think it's totally one of those, when we get into the diligence process, more than I'd say 7 out of 10 times, it's the first time people are going through it when we're doing it with them, and there is most of the time a complete surprise as to actually what that process entails. It does depend on stage. I think if you're an early stage business and like as you said, investor, if you're raising money from a high net worth individual who's putting in some capital to kind of seed your business as an angel, there isn't actually that much to diligence, right? There isn't a whole load of history. There isn't a whole load of historic contracts to look at, so there just is less that you can do. But I think from the kind of the growth capital stage upwards, it is a big part of your process. And I would say, to answer the question about timing, do think about embarking on that investment journey when you feel like you can go through that kind of relatively detailed diligence process and you've got your we use the phrase house in order, and what that really means is, have you got your numbers ready to present, and if people are asking you questions in the detail, you're relatively well prepared. You will not have all the answers, and that's okay, but at least have the information at hand, I think is really important. But get ready, because I do feel guilty when we're going through that extensive list of questions. This is my chance to say sorry, Chris.
That's okay.
But we do recognise it's full on, but it's important.
Yeah, of course, and it's valuable to both the investor and the business as well, because I think also, when we've talked about this in terms of board meetings, the whole purpose isn't necessarily to just be reporting, it's to learn things about your business that you won't necessarily find out otherwise, or you won't be, because you're frantically running around solving problems all the time as a kind of founder or CEO, or and being that kind of due diligence process, again, it's one of those things where it's actually like, let's get to grips with every single area of this business.
Yep.
And that will show kind of both of you, things that you essentially need to know. The more you know, the better. And it's one of those processes, of course, it's very in-depth. But yes. There are ways, in the same way as if you're managing someone and you ask them to report on something, it's not just so that they do some homework, it's actually so that they know why they're making decisions. Yeah, correct. And whenever we have finished a diligence process, the most important thing actually for us at that point is, have we got a clear list of things that we as investors and the business collectively and the team have all learnt about what's working really well and what needs to be improved, and that then gives us really great things to go in and tackle and change. And some of those can be really, really boring things on accounting, controls and processes, and some of those might be, we will do a digital marketing diligence on occasion where that will give really important practical strategic things that you can change going forward. So it is about that list of what you've learnt as the main output of that process. So it's very good to hear that you have seen it in that way as well. And I think what was really interesting when talking about kind of either red flags or the initial stages of a business as a whole, or kind of your view on when you originally meet people and the types of kind of business and people you invest in. When we were kind of speaking about this episode, you said, I worry about the way entrepreneurship is portrayed. It's shown to be a lifestyle choice, and as investors, I often meet founders who come with the perspective that what will impress us is if they play the act of an entrepreneur, when in fact being obsessed with your business and what makes that amazing is where the focus needs to be, and being an open individual with challenges you faced and kind of where you need to help is what you need to do. So this makes so much sense, and in reality, I'm sure kind of there are people who will potentially try and portray themselves in a certain type of way in a pitch or online, kind of glamorizing this idea of like entrepreneurship and acting like an entrepreneur. What's been your experience with this kind of misrepresentation of entrepreneurship? Yeah, I think it can manifest itself in a few different ways. I think one of them is this impression, maybe partly driven by social media and other forms of media, of needing to really project this image of success and come in almost a kind of a macho way, where you go, you like I said in what you just read out, you play the role of the successful entrepreneur, and you walk in and that's what you think people need to see as investors need to see, and that's what investors are buying into. And I think that is one manifestation of it. And what actually instead really, really does matter is just be all over your business. That's what we get excited about with entrepreneurs, is do they know what they're trying to achieve, and are they in the detail of where they're taking their business and the decisions that they're making? And that's really what we're looking for, as opposed to this illusion in some ways of what success looks like. The other thing is being open to not having all the answers. So let's talk a bit about TALA here, if you're up for it, Grace. Absolutely, roast me. Yeah, let's go for it. No, honestly, you're going to regret it. No, you might regret that. No, I'll be nice. I think that part of that glamorization of entrepreneurship is being sometimes excessively confident and hyper confident, which makes sense in the sense that that's why one of the reasons why people become entrepreneurs, because they do have self-belief, and that's really valuable, and that's a big part of where success can come from, that kind of inner drive. But also coming into meetings with investors, and it might not be that first pitch, but as you're going through the process, which was your question,
being open to what you do know and what you don't know.
Absolutely.
And where you need help and support and input. And I think that we need to, as investors, quickly see that people are open to that, and we're able to break down the barrier and have difficult conversations.
Yeah, no, absolutely. And okay, when we were doing that, so I think what's really interesting is, you know, when you're pitching and when you're doing a funding round, and you pretty quickly know who are your kind of favorite funds and which ones you're going to go with. Undoubtedly then, when you're going into those pitches, you're going to want to be, from my experience, but also from, I'm sure, you know, anyone else who's about to go into maybe a funding round, you're going to want to absolutely come across as confident and obsessed with the idea and the industry and everything as possible.
Yeah.
But of course, there are going to be big parts of the business that I know that I kind of was like, oh, I actually don't know how to crack this or anything. But it's hard to know when the balance then is between showing those things and being like, let's talk about it, and thinking, oh, could this make the deal fall through? Ultimately, once you've been through the due diligence, the things that make the deal fall through are the things that are actually not working. It's not kind of...
It's not the fundamentals of the business. Yeah.
But where's that line?
Yeah, it is... I think you have to read the situations, and I think I'm going to roast you a bit, but I think about, we had a meeting, if you remember, I think it was in the Venrex offices, where we were going through some of the new product. I think maybe it was the outerwear, and we were talking about returns or so on, and I think so we're quite in the detail, right? We're talking about real operational potential issue that might come up in the future, and I think that a couple of times your response was, but we're not going to have returns because it's amazing. People are going to love it.
Did I say that?
Yeah, I think so. But it was coming from a place of, we were also talking about why the product was amazing. So it was an aggregate conversation.
Right.
We were talking through the detailing, and I think that there was a real sense. It was super authentic. There was a real sense of, you do have such belief in the product, which is amazing. And I also got the real sense of you wanting to impress us, which is also wonderful and positive, and that is a part of the dynamic. But I would say the balance is then recognizing, you said it just now, that was never going to be something that was going to make the investment ultimately not happen. It was a conversation about problem solving, finding a solution to a specific issue and working through it together. So I think the balance, if that's your question, is think about when an investor is actually trying to have an operational conversation with you about something that's about the future, rather than, and wanting to work on that together, rather than, is there something more fundamental? And always, put your best foot forward in those areas. Be confident and be really proud of your business, but be willing to engage.
Absolutely. And so then let's talk about that. Let's talk about the investment. Let's talk about kind of the process. So from the beginning point, what interested you in TALA? What did we do well? And again, what didn't we do well? Yeah.
Okay. So if we think about the list of attributes of an investment that we look for at Active, as we looked at TALA, it was pretty clear we were ticking through those boxes. So now I'm going to boost your ego and say, an ambitious visionary founder, who understands their demographic well. That was a big tick. A large market. We're really big believers in apparel, and specifically within sustainability, and specifically within activewear. We've got good experience in the category as well, so we understand it. So there was a fit of the market itself and our experience within it. There are interesting paths around future ownership for this kind of business, and general investor appetite and market excitement for especially sustainable brands and that are doing it authentically. And our ability to partner together was really, really important as well. And so I think the combination of those things got us excited pretty quickly. And felt like it was a really good fit for us. And I think the last thing I would touch on is people again. But by that I mean the dynamic that you have with the rest of the business and the rest of the organization. So with you and Morgan, the MD of the business, and how the two of you share really complementary skill sets, but recognize each other's strengths and areas where there's less experience. And I think that dynamic actually felt like you've been working together for years. And so that combination, I would say, in relatively early stage businesses isn't always there. And so that strength of the partnership was also something that was really important to us. And then what did you do not so well? Well, we talked a bit about the point on maybe it took a bit of time to start to get into authentic, proper conversations about what might go wrong. And that's a really important part of getting alignment, as we talked about, and being able to get those conversations pretty quickly. And apart from that, honestly, I don't think there is much you got too wrong. I would say that you were responsive and you moved at pace through the process, which is also really important to people. And I think that making sure that investors kind of know where they stand in the process is really important. You did have a lot of interest and you had multiple term sheets and you were in that fortunate position. And I think that you did a pretty good job at navigating through those multiple conversations. But it's something I would always encourage people to kind of keep in mind.
Yeah, no, absolutely. And it gets complicated at a point if, for example, you have multiple term sheets and you're kind of talking to different people and actually trying to work out a deal that is exactly what you want, but without, crossing what might take too long, or like times and all of these different things. And also in terms of there's, for people who haven't been through a funding round, there's a point that you get to exclusivity,
yes,
where you're going to try and close the round in about 4 weeks and you're not allowed to talk about it. So you also can't let people know if they're not in the running, but you also don't want, in case something happened and it didn't go through, you obviously don't want to be like, no, go away,
yes,
we're fine,
yes,
like I found one now. And you also can't be like, yes, cool, let's continue the conversation. So how would you say that people should kind of keep up that contact and do that well when they legally can't in certain ways?
Yeah, it's not straightforward. I think that trying to have given as people in the process clarity prior to, as much as you can prior to signing exclusivity is important. And then during that period of exclusivity, focus on getting to state the obvious, focus on ultimately getting the deal done as quickly as you can from both sides of the table. From the investor side of the table, you have to get the work, you have to get through the work, and it is going to take as long as it is going to take. But I think in that period, trust is really, really important, actually. And so not rushing into that is what I would advise people as well.
Yeah, for sure. And so for people wondering what it's like to be an investor in TALA and a board member as well.
Indeed.
Can you tell us the inside scoop?
The inside scoop. Oh
I personally would love to know.
Here we are, a few months in, Grace.
Yeah.
I think it's been a really wonderful start, and I'm not just saying this because you're asking me.
He's got a gun to his head.
Yeah.
For people who are listening on the audio.
It's here, I promise. No, I think that we, because of the combination between you and Morgan, you've got some of the basics right at the outset. And by that, I do mean partly the reporting, where the quality of information is good. And so that means that as an investor, I have a really clear idea walking into any board meeting or any other conversation that we're having outside of board meetings, because of weekly updates that get circulated and so on, of how the business is performing, against the plan and the budget that we've all aligned on. And having that information relatively freely available and accessible is valuable and very helpful. And then in our board meetings, I think that means that we have proper conversations. Yesterday, right, we were going through the product and what's coming, and I can't reveal too much, but lots of really, really exciting things. And so being able to have the time and the bandwidth to talk about those kinds of things makes for a really exciting board to be on as an investor. And I think that we can get into the detail on the things that really matter, whether that's product, whether that's marketing. But between you and Morgan and the rest of the team, I think there is, like I said, great information flow and a good amount of forward-looking thinking. But I think the thing that we need to carry on doing, or to turn this into a board meeting, is keep thinking about what's coming next. What's coming next.
Yeah.
And I think what got TALA from A to B, and this is the same for lots of other businesses in our portfolio, what the success from A to B is not going to be the same thing that gets you from B to C.
And it's about working out that formula and being able to test things, but also being able to really clearly look at the data and be like, actually, well, you know, we can't scale whatever this was that got us from A to B. So how do we, or in the same way as we would need to, so how do we create a formula that does allow us to scale and does allow us to get in those directions? And I think that one thing you say about the team as well, I think a lot of what I've been trying to portray recently online in terms of the journey of TALA is exactly that. Like, it is nowhere near just me, like not even in the slightest. I mean, I'm like a 20th of the team, if that, but you know, beyond that, it's kind of having really, really fantastic people in the room who are so determined to make this happen. And we believe so strongly in disrupting this industry and in turning around what, you know, people expect from their activewear and how they shop activewear and all of these things. We believe in that so much from all different areas of expertise that I would really say that, you know, has been a lot of the, I mean, I guess the biggest privilege for me in founding TALA has actually been about finding people who are genuinely enthusiastic on a daily basis to sit down and be discussing the most ridiculous things and just be like, why won't this work? And like, how does this work? And actually, no, we thought it was going to work like this, but actually I don't think it is now. Like, let's all get round this table and let's just mash this out. And that is kind of, we still very much have that. I still call us a startup, but I mean,
if you want,
technically we're not.
If you want to give people the inside scoop is, there's just lots going on, right? And talent and hiring the right kinds of people is such a big part of that. And also, how do you maintain culture throughout that process of rapid scaling of the overall organization and the number of people that are here? And I think that's, you've created something where your team are so passionate about what they do and are so excited to be here at TALA. And now this next part of the journey is, how do we keep that special energy and that special culture, that dynamism? That's what a big part of, I think, your energy is actually going to be on a day-to-day basis, alongside finding and creating the best product for people. Absolutely.
So before I let you go, one piece of advice to someone who's decided that now's the time for them to get investment.
To state the obvious, know your business inside out, so that you can understand and accurately appraise whether now really is the right time to do it. And by that I mean, don't worry about what the investment industry portrays as the right time, but look at your own business and your own journey and decide if now is the right time. And if it is, then know what your business is inside out and what you're going to do with that money.
Fantastic. Well, thank you so much.
Thank you so much for having me. Grace, it's been a pleasure.